Good afternoon, everybody, or I guess good morning, depending on which time zone you are tuning in from. Thanks for joining us today. So, for those who I haven't had the pleasure of meeting yet, my name is Mike Drennan. I'm the managing partner here at Fairport Wealth. I have the pleasure of sharing the screen with my colleague and our Chief Investment Officer, John Silvis. John, how we doing today?
Doing well.
Yeah, sure the weather there is as nice as it is in here in freezing.
It's
This
a
spring.
lovely 40 degrees, I think. So,
Yeah, hoping
not
at
too
some
bad.
point. Yeah, I was hoping at some point we get a spring. John knows this. We have a new puppy. And I have to say that it's not been pleasant taking the dog out at night. I thought my wife and I had timed this a little bit better, that we'd get him right when spring was coming, snow would be gone. Should have known better, right? It should have known better. I also should have known better. This was supposed to be our dog. I've got four kids, right? We were all going to share in the taking out feeding. That was wishful thinking, right? It's Mike's dogs now, so.
I got suckered into that once, Mike. It doesn't work that way.
Yeah. So, needless to say, I wish spring would come. We know it's going to go from winter to summer, but um, I want to start by thanking everybody for joining us today, especially on shorter notice. Just given where the market is right now, what feels like daily happenings, updates, changes, we felt that it was really important to get this webinar scheduled, have it be live, and do it as timely as we could. So thank you guys for making the time. As always, we are delighted to be welcoming our clients from all of our 6 offices. So as a reminder where we are located: Chicago, Illinois, Cleveland, Ohio, Harrisburg, Pennsylvania, Buffalo, New York, Princeton, New Jersey, and Cherry Hill, New Jersey. So 6 different offices. So thank you all for making the time. And also, before we get into this, I did want to take a moment to personally thank each of you for your continued trust in us. It's an honor for us here at Fairport to serve you and your families, and I want you to please know that we do not take that trust lightly. It's honestly what gets us up each and every day. And for me, it's crying puppies as well, but enough puppy jokes for the day. Um, so, John, I mean, to say that things are moving and changing rapidly in 2025, I think would be an understatement, particularly over these last few weeks. And I know today's goal of this webinar is to help cut through what I always talk about being noise. To me, it's noise. Um, but there's headlines, and I know many of you are reading them, you're hearing them. It's tough to get away from that, right? So, goal today is to help cut through that. And as we normally do on these investment town halls, we want to give you an opportunity to hear from us, hear from John, our thoughts, our perspectives. And I think, to me, at least more importantly, it's another chance for us to hear from you. So please ask questions, right? We want to hear from you. Some of you have sent those in advance, which we appreciate. But also, because of where we are today, we decided to do this one a little bit differently. I know in the past, for anyone who's joined, John will typically pull some slides and we'll walk through a couple different topics, but we want to make this conversational today. We want to address as many of your questions as we can. So we've taken the ones you've submitted, as well as frequently asked ones that some of our advisors have shared, right, to help guide today's discussion. So in terms of agenda, so we are going to start by putting John on the spot by giving us a quick update on, hey, what's happened? For anyone that's living under a rock, right, a lot has happened. So where are we, right? And what's different than maybe what we thought coming into the year? John and the investment team each January, I know, puts out their thoughts and themes, right? And so I think he's gotten some right so far, right? So even though we're only
Yeah.
4.5 months in, but we'll start with that. We'll touch on the economy and markets. We'll talk about our Fairport investment philosophy and strategy. So what changes, if any, have we made? And then we'll end with looking ahead, right? What is John looking at? What's the investment team paying attention to here in the next couple of weeks? So I did want to just start with saying something as well. I know we've gotten asked this question a lot. I know our advisors have been getting this frequently. Is that this time feels different, right? Feels different, and you're right, and that's because it is different. But I think it's important that we all keep in mind that it was also different when COVID happened, right? Most of us had never experienced something like that before, or what happened in the financial crisis. And I guess you could insert any crisis in each of your lifetimes, right? It always feels different. But at the end of the day, Fairport's mission and what drives us each and every day here is to help you achieve your financial goals. So part of that journey includes our team helping you to not make decisions based on emotions, right? As hard as that is, we know that's not easy. It's not easy for myself and my wife sometimes, right? But we also know that we're here to help, right? That's our job. That's why we're here today, to have John share perspectives on, hey, despite everything going on, how does this impact you? To us, right? We think there's not a need to panic, but I think it's certainly fair to ask, hey, are we still on track? Right? Are we still on track to hit our goals? So I want you all to know that, please, we always have our hand on the wheel of the ship, and we want to be that calming voice for you, certainly in times of uncertainty and chaos, right? That's important to us. So the other thing I'd point out too, before we get into investments, and I know we're very focused on investments today, but every client situation is different. And I think it's important in times of volatility like this, that this does bring to light an important topic for our advisors, which is risk tolerance, right? We create financial plans based on our understanding of your risk tolerance, which means what, right? What means in times of stress, how do you feel, right? Are you willing to accept volatility? And that changes over time, right? Depending on what stage of life you're in. So there's no right or wrong there. Obviously, it's personal and unique. But I think what you'll hear today from John, right, is a lot of, well, we'll be consistently saying this throughout, is that there's not a lot of change for us, right? We're going to stay the course. We're long term. But I do think it's fair as a takeaway team, right? In terms of, as I think about what you can do, I think it's important that you could revisit risk tolerance, asset allocation with your advisor. I think those are fair things to talk about. So with that, one piece of housekeeping, and then I will shut up and I'll start asking John, put John on the spot and give him the tough questions. So as always, you are muted on this webinar. And while we'd love to see your faces, we cannot. So if you have any questions, please put them in the chat. I will do my best to multitask. Sometimes I'm not the best at that, so I apologize if I don't. John's going to help me keep myself on task to make sure we're addressing as many as we can, time permitting. So with that, I will shut up and I'll toss it over to John with the first one, which is, John, I think it's important. Why don't we start with, where are we, right? What's happened over these 4.5 months? And really, people really probably want to know what's happened these past 3 weeks, right? More or less. It feels like microcosm of the year has been 3 weeks. So what's kind of happened so far?
So we've done 20 of these, Mike. This is our 20th one, and I'm going to give you the award for the longest intro.
Thank you.
So you're welcome. But yeah, that's a great question. So what's happened? So we had the first quarter. Markets were down slightly in the first quarter. I think what's changed, or what was the pivot point so far? It's been in the last 2 weeks. It was the Liberation Day, which was on April 2nd, and I think the administration came out with probably tougher tariff policy than people anticipated. That kind of got the ball rolling as far as where's the market and is it situated for that. But bigger picture, we're down. This is as of yesterday's close, not counting today. We're the S&P 500, which is one of the big benchmarks out there, is down about 7.8% for the year. The ACWI, which is something we follow closely, but there's also international equities involved in that as well. It's down about 4%. But from that peak in February 19th to be exact, through yesterday, the S&P is down about almost 12%, 11.9%, and the ACWI is down about 9%. So we've actually seen international equities do a little better than domestic equities, which has been a trend change over the last several years. I don't know if that's a rally or a trend. We're keeping a pretty close eye on that as well. But I think the bigger point is, if you really take a step back, and we talk about long-term a lot and how we view things, and I'll get into philosophy in a second. The S&P is up about 8.2% over the last year. So we're still right in that 8 to 10% range, which is typically what equities do. If you go back 3 years, as of yesterday, it's averaging 8.8%. So, there's a lot of movements in the market. I think one of the things we mentioned, that you mentioned, Mike, on our 10 themes for the year, is we thought we'd see a correction of 10% or more. And we have. You never know when those are going to happen. To say that you can plan ahead is somewhat futile, but sometimes you might see it. But again, we thought we'd see something like that. It probably came a little quicker than we anticipated, and probably a little faster as far as the declines go. But again, we were overdue for one, so not something that we're totally shocked by. Bonds, on the other hand, are actually doing a little better. For the last year, they're up 6.9%, and we've seen bonds struggle over the last 4 or 5 years, really coming off the COVID low. So a little bit of a trend change, as you mentioned, though. What is different this time? There's an old saying that the markets don't repeat, but they often rhyme. So every time's always a little different than the time before, but there are certain patterns to the world, and I think we're seeing some of those as we go forward. We saw some volatility coming off that April 2nd announcement with bonds. You saw go from a low of 3.8 this year back up to I think 4.5%, or we closed yesterday about 4.3% on the 10-year Treasury. But to kind of go back to what you were saying, and I like to always say this to myself, we're looking at the next 3 years, not the next 3 weeks or next 3 months, because I think that helps, center your focus on what we're doing for the long term. And, as an investment philosophy, and we've said this many a times within our meetings with either prospects or new clients, that really, our goal is to stay invested over the market cycle. We're not really looking to market time or, make concentrated bets, meaning, we're going to be at 50% in tech and, nothing but large cap growth. We're looking to diversify over multi-asset class or multiple asset classes. We use the MSCI as our benchmark, and we do rebalance, and I'll talk a little bit about that as we go through this. And when appropriate, if the opportunity arises, we also will look for opportunities to do tax loss harvesting, and I'll mention that as well. I always use the saying, you take what the market gives you, and at times when the markets do have some of these drawdowns, that's usually an opportunity to take losses if you can. It's painful at the time, but it tends to be a benefit going forward. So that's something else we've done. Other than that, we try to stick to that philosophy, as I said earlier. What have we done differently? I can get into that. We talk a little bit more about portfolios, but again, I think staying grounded is probably the most important part of that. As you said, look at your risk tolerances, look at your asset allocation. I firmly believe if your allocation is right, then a lot of these, you weather these storms pretty well as far as a risk reward standpoint. So that's kind of where we're at today. As far as the inner gyrations, we can talk about tariffs and all those things if you want, but we're going to see this all kind of work itself through. I think there was a 90-day reprieve. I'm not sure when it happened. It was last week sometime. So we're in early stages of that, and I'm sure we'll see more headlines coming up. But my recommendation, and I've been on a lot of calls with clients, hopefully some of those people are on the line today, is unless you have a change in lifestyle, and that's something you talk to your advisor about and work through those issues, retirement, whatever it might be. I think at this point you want to stay the course as far as your allocation. We're not really recommending any allocation changes other than maybe lifestyle changes, and again, that's a whole different thing, regardless of market gyrations. So that's kind of where we're at today.
So John, I know I mentioned you put up those thoughts and themes. So hopefully people have had a chance to see that. And you read those through and you're like, wow, John, you did a pretty good job, I think, so far. Some of those have come through, right? You still got some time, but I know you didn't have this one pegged when I say this, everything that's happening. But I think tariffs aren't a surprise. And this is not going to be political today. We're not going to not dip our toe there, but we knew something, right? We knew tariffs would be part of this administration. But I don't think you saw this coming, right? In terms of this.
I mean, I think we all knew that, there's an old saying, I think President Obama said it first, but, elections have consequences, right? And when there's change in leadership or administrations, you're going to get changes on policy. And I think we all kind of knew this was coming, how fast and maybe how deep the changes would be, I think caught people off guard. But I don't think anybody had these numbers written down ahead of time.
Okay. Is there anything you would say, right, in terms of, again, I mentioned that this feels different, in which it is, right? But in terms of the pullback, anything for you that stands out, that how this could potentially be different than other times?
No, I think it's, it sounds too simple, but I think it's been somewhat of a textbook correction. Probably went a little deeper than we thought. Again, I think the uncertainty on a day-to-day basis or hour-to-hour basis probably was one of the catalysts for that. But I think one of the positive things that come out of that, we saw there's something they call the VIX, which is volatility, how fast the market moves from high to lows and things like that. And higher the volatility, more more uncertainty there is a feel to the markets, or sentiment gets very low. But that being said, volatility was very high over those weeks, first 2 weeks of April, and there's a silver lining out of this. We got to a measurement of 60, which I won't get into the nitty gritty, but usually that's a pretty high reading. You don't see them too often. Since 1990, we've seen it 75 times, and so we were in the top 75 occurrences of this. But the reason I bring it up is the 1, 2, 3, 4, and 5 year returns after those points, and all 75 times were positive. So if there's a silver lining in these things, I think we kind of washed out. So to your point about the correction or where we're at today, could we see a retesting of low? That happens if you're looking at the historical patterns. And I think one of the questions popped up: do we use technical analysis? We do use technical analysis, especially on things like levels, where we think the markets will go, retracements, those type of things. I don't talk about them a lot to clients just because it gets a little wonky. But we're looking at those levels, and I don't want to say the worst is over, but I think as far as the trend goes, we've seen the pattern that's kind of unfolded before, and I think we're in the second half, or either we're in the bottom or the bottoming phase, and I think we're to make changes today would be a little bit late, I think, in the process.
Right. But to your point earlier, right, we're not looking to time, right? When you're making a decision, we're not looking to time this. But I guess and by the way, Robert, thank you for sending your question. Keep coming in, please. We're going to keep going through those. But volatility, obviously, it's back. It seems like, right? Clearly, how long do you think that continues for, right? And is it in your mind based purely on the China-U.S. negotiation? But what are your thoughts there?
Well, the old saying in markets, climb a wall of worry, right? And when the longer list of worries or issues get longer, volatility or uncertainty tends to rise. And I think they all kind of go hand in hand. We saw the reprieve of the 90-day extension. We had a question internally a couple of days ago, what happens after 90 days? And no one really knows at this point as far as the Trump administration and what if and when they will pivot. But so I think the volatility is probably a spike. Could we see another spike up in those 50 to 60 ranges? It's possible. But we've already seen it come down quite a bit. Again, because of the reprieve on that, we've had some pretty solid economic numbers coming in. So the concern of maybe imminent recession is probably waned a little bit. So I think that's come down. If we see more policy issues or headlines or uncertainty in some of the data that we're getting in real time, then I could see where we could see another spike. I don't think we'll get to the highs we saw last week. That was kind of, those were like, more COVID lows type of numbers, and or great financial crisis type of numbers. And I don't think we're going to revisit them, but I reserve the right to change my mind.
Yes, that's fair. So let's dig into the economy and markets. So let's start at the top with economy, right? So in terms of where we're at, there's been a word that gets thrown around. I feel like people have been trying to figure out when it's going to happen. It's just a matter of time on the recession side, right? How is the economy doing? Are we in a recession? And what causes, or should we be paying attention to have us be worried, John, as we think about that?
So, recessions are a normal part of the economic cycle. I don't like them, and I don't think anybody does. I don't know if my observation would say we're not in a recession yet, but I think the concern is, and why there's a little bit of everybody's looking shorter term versus long term, is because there's going to be this change in policy of higher tariffs, and how does that affect the economy going forward? I think everybody kind of views it as a negative. It's kind of a negative effect because of rising prices. It could stoke inflation down the road. But as we finish the year, and we finished the year about 2.5% GDP growth in all of calendar 2024. So we finished on pretty solid terms. We came into the first quarter. We're going to get those. We'll get some numbers on the first quarter here pretty soon. But my guess is we had some slower growth in the first quarter. And one of the things we mentioned at the beginning of the year is we thought we'd see a growth scare in the economy, where not necessarily a recession, but where you see things kind of downshift for a period of time. And that's pretty common when you get into these economic expansions, you have these walls along the way. So that wasn't it wouldn't be unheard of, and I think we're probably seeing that today. Do some of those turn into recessions? Yes. At this point, I don't think that's the case. I mean, just recently, retail sales came out today. They were pretty good. Unemployment claims are still well within acceptable ranges, around 225,000 a week, which sounds like a lot, but that's a pretty tame number. The company surveys that I've put out slides on in the past, which is done by it's a proprietary thing by Evercore, but tends to have a pretty good recession indicator to it. Hasn't ticked off yet. Payroll numbers for the month of month of March were pretty good. A little better than expected. So we're not seeing that where we're missing the mark constantly, which tells you things are slowing down. And I think that what's different is everybody's anticipating that happening when the tariffs take effect. And then, so they're all waiting. But as of today, I don't think that's the case. I mean, inflation was at 2.4% year over year. The core number, which includes gasolines, at 2.8. Not the 2% target that the Fed would like, but well off what is considered the average inflation. If you go back 50 years, is about 3.5%. So I think we're in an acceptable spot. I looked up this morning just because I was curious myself, but gasoline prices are 50 cents lower than they were a year ago. So I think right now things look okay in the economy. It's more the uncertainty going forward. And again, because we don't know what the policy will be, there's creates more uncertainty. And our colleague, Rick D'Amico, was pointing out in some of our internal comments, that there's a fear of pricing in recession as prices will go up because of the tariffs. Now, that hasn't happened yet, but we could see that in the second half of the year. And I think that's what everybody's kind of waiting for and why there's so much concern around recession talk. But as of today, I think we're still pretty good. Now, again, the other thing is people could be pulling all their purchases forward. I know auto sales went up recently, the last couple of weeks, because they're thinking, well, if there's tariffs on all the cars coming in from foreign manufacturers, you're going to see a rise in prices. So, you pull it forward, you get really good economic data, and then a month, 2 months from now, it tanks because everybody bought ahead of time. So we'll see how it plays out. But I think, as of today, I think things look okay.
Okay. So inflation, I think you mentioned that quickly, right? But I know in your thoughts and themes, another thing you said, hey, that's a 2024 story, right? Not going to be an issue for 25. How has that played out? How has that played out so far?
I would say that one's still to be determined. But so again, inflation over the last 2 months, especially the one we just got, I think last week, was at 2.4. That's for the month of March. And, again, those numbers tend to be backward looking. So everybody's saying, well, that doesn't matter as much. Let's look forward. And that's where the issue is. So to answer your question, do we see inflation back up above 3% on the core number or the headline CPI? I think that's possible. So, we may get that one wrong. I think where we probably, if we do get it wrong, and I'm not throwing in the towel yet, is because I think the tariffs were higher than expected, and that drove prices up, which at least, and I hate to use the Fed's term, from a transitory aspect, will make inflation at least spike. I don't know how long that lasts. We've been down the transitory road before, so we'll see how that works out. But yeah, I think inflation is pretty well contained today, but it definitely looks like a second half of the year story. But we'll see how all the other policy plays out ahead of time.
Right. And speaking of one, and I know there's a couple, we'll get to these questions in a second, but one more for you, John, from questions that have come in before, interest rates, right? So another one that people have been trying to time. How many, when, obviously, I think you can have your own point of view on what Trump is or is not trying to do to influence that, right? And the Fed has been seemingly quiet during this time, right? But in terms of your predictions for the rest of the year, how do you see that playing out on the interest rate side?
So, if you go back to the beginning of the year, a lot of the comments were maybe maybe they'll cut rates once, maybe twice. I think the Fed's prediction was twice. I kind of thought at the time we'd see more than 2 cuts for various reasons. But I think as the market anticipates it today, I think it's 3 cuts and slightly leaning towards 4. That doesn't mean the Fed's going to do that, but that's kind of what the market expectation is today. So, uh, the Fed will come out with some newer forecasts, but right now they're looking at two rate cuts. I think it's likely more at three. I think where they're stuck, and again, this kind of goes back to the whole concept of tariffs, is they don't want to cut rates now, looking at today's inflation with the thought that there's going to be higher inflation when prices change, if they change. So I think they're kind of stuck between a rock and a hard place on this one. I don't know if they'd come out and cut today. I think the two things that will cause them to cut is a slowing of the economy, which probably means we see unemployment go up. So I think they're holding out, but I think the markets predict the June cut is the first one of the year. Those things change pretty quickly, but that's kind of where we're at today. And as far as rates go, again, we saw they come down from, I think, 4.8% down to about 3.9. Now they're back up around that middle mark of 4.5, 4.30. I think we're going to find some equilibrium in here, and I think somewhere between 4.5 is probably where they should be. I know people look at the mortgage rates a lot because of that. I mean, as we got down to 3.8, I think mortgage rates were well under 7. So people and mortgage applications came out today, and they were actually higher than expected last week, probably because of that. A lot of people trying to game the system, trying to game the systems on autos, trying to game the system on when do I get my mortgage, when do I refinance. So there's a lot of uncertainty, and that causes people to try to lock in, and sometimes that's good, sometimes it's bad. But I think overall the economy is on firm ground, but it's definitely getting slower. And I think the concern is some type of policy mistake will push us over into a recession. I'm not going to subscribe to that yet.
Okay. So Martha asked, how deep do you think interest rates go? We won't hold you to it, John, if you're wrong.
How deep, meaning how low?
It seems like I think that's what she's
Well,
asking.
I think interest rates declining probably will be tied to the economy slowing and or slipping towards either no growth or a recession. So I think if we see slower and slower growth in the second half of the year, and more of these data points coming out on the lower end than the higher end, I think you'll see rates go lower. I'm gonna, if I had to go out on a limb, I think 4% is kind of the low range, and I think 4.70 is probably the high range. I think we'll be in that range some part of the year, but as we've seen, things move quickly. Headline can change rates by 20 bips. I mean, it's happened pretty quickly, and I know the other thing is if inflation goes up, rates probably go up. So there's a lot of moving parts there, but my guess is somewhere the fair value is probably somewhere between 4.75, somewhere in that range.
Okay. I know we had a question on the real estate markets, and John, it's not fair to ask you all things, right? You don't know all things, but any thoughts on what's going on there since we're talking about rates?
Well, I will tell you, my neighborhood houses go pretty quick. But
Here
I don't know if
here too in Massachusetts, for sure.
Yeah. So, bigger picture, not just residential, but just real estate and in general, that has gone through a rotation here because we saw rates go higher. That tends to put a damper on real estate. We've also seen the office space going through a transformation because not everybody works in the office anymore, right? So as leases come up, and we've seen that with ourselves, people are renewing them. They're deciding maybe they don't need as much space. So the office space the office real estate end of the market's been pretty soft. Residential's held up fairly well. So I guess it really depends where you're at, but I think we're probably in the bottoming cycle of real estate. So I'm not recommending anybody run out and buy a summer home, but I think we're closer to the end on that as well. So we'll see. But they're always going to be dependent on direction of rates.
So we had a couple questions. I know tariff is going to be the word du jour today, but from Michael, so if tariffs go into effect, will we have problems? If yes, what hedges should be embraced now?
Well, so if tariffs go into effect, I think they're going to go into effect. The 10% across the board, I think, is I think that's a done deal, so to speak. The reciprocal parts, I think are up for discussion. That's why they did the pause. I think, if I'm not mistaken, it was Japan that's going to meet with the president today in the White House,
I believe
their
so.
delegation. So that, you could see some headlines on those things. But so we're going to have, if it's the 10% and most of the other ones, maybe outside China, are either pushed out or delayed, I don't think it has as much effect. But if we do go through this ramping up of all these reciprocal tariffs, and then there's what they call them, sectoral tariffs, I think, come after that. I don't know. So there's a lot of these discussions. I think it's going to have a negative effect, and we're going to see the economy continue to slow until there's some, definitive outcome. I think if you were a CEO of a company, and you're trying to figure out how to get your raw materials from one point to another, or get them imported into the U.S., I would think it's a very difficult job, right? Do you front load it and buy too much, and then find out the tariffs don't go through, or do you wait and then pay higher prices later? So I think there's a lot of uncertainty there. But generally speaking, tariffs are a tax, and taxes tend to slow the economy. So I think the least amount we see, the better.
So while we're talking about, let's talk about markets. I know there's a couple other questions here. I'm trying to make sure we time this so we don't jump all over the place, but we'll get to your questions, Ron and Matt, I see. As it relates to markets, John, let's talk about sectors, right? Which ones are leading? What are you guys seeing, right, on that end, just given everything that's happening?
Yeah, so the Mag 7, not really a sector, but it's mostly technology, and that's kind of what everybody hears about. It's the NVIDIAs and the Microsofts and um, Teslas of the world. There's couple other, Facebook and a few others, but they're down about 19% for the year, at least as of yesterday. Now they have had a little bit of a bounce here recently, but they've definitely shared the brunt of it, and they're the larger companies, so you start to see everything outside of that, the 493 as they call them, in the S&P 500, not the Mag 7, aren't nearly as haven't done nearly as poorly as the overall market. So there's definitely a rotation, into the ones outside of the larger names. Last 2 years, you could argue that most of the returns came from the top 7 or 8 names, top 10 names. I think you're seeing a reversal of that. So as far as sectors go, one of the things we mentioned at the beginning of the year, we thought tech would have a good year, but not be leadership. It's definitely not been leadership so far this year. I wouldn't argue it's had a good year yet, but it's definitely not been leadership. But we still think the cyclical areas of the market will hold up better than they have so far in the first 3.5 months. So we're talking, again, maybe not as leadership, but I think technology, consumer discretionary are 2 areas we like. We like financials. I think they've been beaten up quite a bit. And then on the defensive side, which has done well in the last few months, the utilities, staples, those are areas, we still think will underperform over the long term. Because again, when we're looking at these, we're looking at, where do we think the economy is going to go, and what sectors or companies benefit from an expanding economy. If we were in a long, protracted recessionary environment, then you buy the Procter and Gamble's of the world and the Smucker's peanut butter and all that stuff, because those are things people need and they're staples. I don't quite think we're there yet, so we'll see. But we're sticking with the cyclical areas. We did take gains at the beginning of the year. Just kind of talk about what we've done in the portfolios. If you go back to the beginning of the year, January, as we turned over the calendar year, and more importantly, turned over the tax year, we did take the opportunity to trim some of our positions, like in NVIDIA and Arista Networks and Apple and a couple other ones at what has turned out to be higher pricing there today. So the first month or two, we were kind of net sellers, trying to take opportunities to lock in some gains. Over the last 2 or 3 weeks, we've probably been neutral or even maybe net buyers, because as some of these things have come down. And then the other part of that is we have looked for areas to take tax losses when we can. So for those clients that have taxable accounts, we're looking to rotate into some names that are either similar or use an ETF that looks pretty similar as far as risk and reward goes, to kind of capture some of those losses. And we've been doing that over the last 2 or 3 weeks. It's all kind of come together at a very busy time of the year, between taxes being due, tax loss harvesting, and other things. So
Well, on top of that,
busy weeks.
I was gonna say, on top of that, earnings season is right now underway.
Next season, right?
Thoughts
And
on
so far,
that?
earnings seasons have been pretty good. It's been mostly financial so far, so it's a little skewed. I think we're going to see some more of the broader names, the industrials and materials and technology companies here in the next couple of days. But overall, earnings are still holding in there. Again, I don't think the first quarter is kind of behind us, and that's not really the issue. It's kind of where the guidance goes going forward. So that could change. And we haven't really seen, again, the banks have a different mentality or different view as we get into people that are selling either raw materials or parts and services and stuff and technology. I think their view of guidance is getting it's a shorter version. Some will even probably pull guidance. Haven't seen that a lot yet, but we'll see how that's going. So we're Mac Muirhead and myself and Mike Kalinowski, we've been looking at the portfolio, and we're definitely anticipating a change in guidance going forward. But how much that affects earnings really goes back to how much we put a tax on those companies as far as what they import and when they import, because no one's going to be able to change their manufacturing overnight, right? You can't, Tim Cook from Apple can't say, well, we'll just start building iPhones next week in Texas.
Tomorrow.
Doesn't work that way. It'd be great if he could, but it's going to take a long time to build a billion iPhones in the U.S. So
Anything else, John, on your end from a market perspective that you would call out or highlight for the our clients here?
Well, so like I said, I talked a little about volatility and returns. There's the old saying, you want to be uh, uh, fearful when people are greedy and be greedy when people are fearful. I think that's a Warren Buffett quote, if I'm not mistaken. So I think we see this more as an opportunity. If you have a 3-year time horizon or more in front of you, I think from an equity standpoint, things look attractive. It's tough to buy at these levels because you think, well, there's more to come, and there could be. But the theory is, you want to take opportunities when you have them. And I think if you're looking long term, that's why I always say the 3 years versus the 3 weeks, because it helps focus on the longer term. I actually think there's some attractive valuations out there, so we're definitely taking a look at those things. We're being cautious as we wade into these things, but I think there's opportunities, especially some of these high quality names that you can get at what is cheaper prices than they were 3 months ago. So that's definitely something we're looking at. I don't think we'll be overly aggressive, but again, another thing I always say to clients when they ask, well, how long will it take to invest the money? I'm like, you take what the market gives you at times. If we're at all-time highs, which historically is not a bad time to buy, we're probably going to be a little slower. If we're at a 10 or 15% correction, we're probably going to be a little quicker, because I think over a 5 to 10 year period, it's a good opportunity. So I think sometimes you got to look at these things as opportunities, not as I don't want to downplay it, but it's just a blip in a long-term trend.
Yeah. When you pull back and look at it, right? So I know we've gotten some questions here as it relates to what we're doing, right? So as it relates to portfolio. So let's jump into that. Let's start at the top, right? So given everything that's going on, John, and I think you kind of hinted at it earlier, but are we doing anything differently? What changes are we making, if any, right? From a philosophy, a strategy perspective, anything from a 10,000-foot view before we start to dig into some of these other questions we're getting from folks?
Sure. Well, I hit on a couple of them. One, I think, we already took an opportunity to take some gains earlier in the year. So I think from a allocation standpoint, I think everybody came into the year probably at the higher end of their range on the allocations. We took the opportunity to pare back a little bit, take some of those gains. So that's one. Two, what are we doing differently? Sometimes it's not panicking. It's the most important thing. So we've been trying to stay focused, trying to keep up to date on what's going on. And there's been a lot of moving parts recently, but try to stay up to date on that, stay true to our investment philosophy. We have taken some opportunities recently to add to some positions. We did reduce our technology allocation, not by a lot, but by 1% or 2. So we're slightly overweight technology, but not as much as we were, because we do think it's going to be probably a bumpy road here for the next couple of months. Long term, I think is still an opportunity. I think the AI story is a very long has a long a long track in front of us. And then for those people in taxable accounts, we've been looking at tax loss harvesting to help them. And then the other things, on a case by case basis, maybe not the 10,000-foot view, but I think for clients that have allocation or have distribution needs or know they're coming, my recommendation is, you need the money in less than 12 months, you probably shouldn't be in the market. So we've been looking and advocating, maybe raise that money now. So because you're going to spend it either way. So that's helped some people weather out that volatility over the next few months. So those are the main things we've been doing. Haven't Another question we get a lot is, we've seen international equities do fairly well here over the last few months, and is that something we're looking at, on a bigger picture from a secular standpoint? I don't think we're going to rotate out of domestic equities into more international. It's something we've been keeping a close eye on. I think it's more of a rally than a trend at this point. But we've seen a few of these over the years where they tend to rally for a couple months and then they return to a long-term trend of underperforming on a relative basis. But there's a lot of shifting dynamics globally, so we'll see how it plays out. Currencies are moving. Obviously, long-term trade partners are maybe not as long-term as they used to be. So there's a lot of things changing on a global scale, so that we could see rotation into international from a secular long-term view, but we're not committed to that yet.
So Ron asked here, so with all that has happened and the red lights that are flashing, the recommendation is to stay the course, question mark?
Yeah, I think if, and I know your advisor pretty well, Ron, so I would think you've had many conversations with your advisor about, what your allocation should be and what your goals are over over this lifetime, and even, generations after that. So I think if you have the right allocation, I wouldn't make any drastic changes, and I think you stay the course. We're to get out of markets now seems a little late in the process. And as we said at the beginning of the year, we kind of expected some type of correction. Giving a number is always kind of futile. So 10% or more, and we've obviously hit that, probably a little more than we would have thought. But again, we are where we're at. So yeah, I think the answer is stay the course. If something changes on a lifestyle standpoint, then I think that's obviously an opportunity to talk to your advisor about it, and then we can change course accordingly.
Right. So Michael asked then, what do we do to hedge for tariffs? Anything we can do on the portfolio side to hedge for that?
I mean, there's probably some minor things, but again, I think we don't really know what the final outcome is going to be, so it's hard to get too far ahead of it. They could extend the 90 days till the end of the year, or they might say we're going to raise everybody at 20% because they're not coming to the table quick enough. I have no idea. I don't know. I'm not part of the administration, and I'm not going to try to guess ahead of what they're going to do. I think that would be really difficult to do. So, I think at this point it's kind of staying the course. I think if it becomes more and more apparent that, let's say, the status quo is going to be the long-term outcome, then I think you can kind of think about that. I do think the inflation issue is one of the concerns. So, as we look forward, that's one of the issues we're going to keep a close eye on. I don't know if that's a good transition or not, Mike, but.
Well, we're going to ask Martha asked the question here, right? Because we're talking about risk tolerance, right? We're talking about allocation. Martha asked, and what do we do to hedge for recession then, right? What strategy should be under consideration if our risk tolerance is low?
So if you have a low risk tolerance, so the first thing I always say in client meetings, especially when we're in points like we are over the last few weeks or last month or two, is at the end of the day, it's your money. And if you don't sleep at night or you're that concerned, then it's not worth taking the risk. And we can make changes to that, either reducing the allocation to equities, or in the extreme case, moving all to cash, whatever that might do. And I think you talk to your advisor on those things. I mean, because there's tax implications and other things that come with doing those things. So that's one thing. If you're that concerned. Again, if we are convinced a recession is on the horizon or we're actually in a recession. Um, we can, move to an underweight in equities. There's a couple things we can do, but again, we're not going to make drastic changes because that's just not really our thought. I think, again, if you have the right allocation, your best course of action is to stay the course. So we'll see. I'm going to be cautiously optimistic that we're going to see a slowdown, but hopefully avoid a recession. We'll see how that works out. But,
Okay.
I could change my mind.
That's fine. So Karen asked to follow up on that, right? Any recommendations for someone who has retired in March and is planning to begin IRA withdrawals? Is it best to try not to withdraw at this time or push off withdrawing?
So I'll defer that to your advisor because there's probably more to that story than those two bullet points. But um, there's a couple ways you can do it. We have people that take RMDs, which is a required minimum distributions, and some people take them at the first of the year, some people take them at the end of the year, some people take them over 12 months, and there's advantages and disadvantages to all those things. So I would advise, if you haven't already, reach out to your advisor with that question, and I think they'll be more than happy to walk you through that process and kind of give you some options there.
Yeah, so I think it just, I know we've said it a couple times, but just in case someone joined late, just to reiterate, times like, I mean, it's the questions we should be working with our advisors on, right? Is do we need to revisit risk tolerance, the allocation, right? Those are the two things. So please, Karen, I don't know your last name, but please reach out to your advisor. They'll absolutely be willing to talk through that with you.
And retiring is like one of those life changes we were talking about that may
Correct.
warrant a change in your allocation. So
Exactly right. Exactly right. I had gotten this question, and it's not from a client, but it has been from neighbors, right? Do I go all in on cash, John?
um I would just say no.
Yeah,
I think,
wasn't a serious question. Wasn't a serious
well,
question, but
I
I have
mean,
been asked
I've
that.
gotten that question many a times, and it's a simple question to ask. There's probably many layers to that question.
Correct.
We
Correct.
don't know, but I would say I can't say never go to cash because there's obviously some situations you might want to do that, but I would think if it would probably be a last resort.
Okay. We haven't we talked. I think you touched on fixed income a little bit, right, as it relates to yields there. But impact in the bond market regarding all the volatility, and does that affect anything on our fixed income strategy, John?
So I'll give you a general answer to that. I don't think we've changed much in our view of fixed income. We've kind of kept our duration a little short of the benchmark, meaning we have a little less interest rate risk than the benchmark does. Um, we have been keeping a really close eye on spreads, which is the difference between like a junk bond and a treasury. The wider that spread gets, the more you have to pay to get someone to be attracted to the junk bond. And the spreads have widened a little bit, which is usually happens when you see areas of kind of disconnect like we've seen, but not to the point where they're historically wide. So, it's kind of normal reaction, but I think it's well within the range. So, um, so that's something we're keeping a look on. If that changes, then that's probably then we'd reevaluate how we look at things. And we've had people that were putting money in the very short term at the 5% or 5.25 you would get on treasuries, 3, 6, 9 month T-bills. And our colleague Rick D'Amico has been on advocating you want to stretch that out a little bit further, probably somewhere closer to 1 or 2 years, just because that's kind of the sweeter spot of the curve. But um, haven't made any major changes there. Again, we've tweaked some of our credit and duration spreads. But if you have a question specifically to the bonds or how you can maybe you have some short-term money and you want to see what's the best yield you can get without taking any or a lot of risk, feel free to reach out to your advisor. Our colleague Rick D'Amico's talked to many clients and we've rolled them over several times. So there's opportunities there as well. I'm happy to do it.
Okay. So I know we're 50 minutes in, and please, clients, keep the questions coming. But John, as you think about what's next, meaning what are we paying attention to? What are you and the team looking at? What are things that may drive changes, if anything, right? What's on tap in terms of what's upcoming?
So I think the big themes we've touched on already is one is, uh, are we on a recessionary path? I'm holding out hope we're not, but does that change, and how does it change going forward? And a lot of that's probably policy decisions over the next call it 90 to 120 days. So that's one thing we're keeping a close eye on. Inflation, does it pick back up in the second half? Our thought was at the beginning of the year it was going to be contained, and I would say contained by 3% or less. Um, that is probably the one thing that we're keeping the closest eye on. It seems more and more people are convinced that we'll see higher inflation in the second half as these tariffs start to roll into pricing. So we're keeping a close eye on that. You talked about it earlier. The Fed, when's the Fed going to cut rates? Right now, it looks like June. It looks like if you ask the Fed, it's 2 times, but I think the market expects more than that. That tends to be a good indicator for markets as when the Fed cuts rates, but it does take 6 to 12 months to work itself through the economy. So that's going to be a concern. And then just we talked about earnings and guidance, so we're going to keep a close eye here in the next couple of weeks on earnings season and where people are guiding. And then if tariffs aren't enough, on a policy standpoint, we have the debt ceiling coming up.
Right.
We did get the budget done, so that's one of the three that are done. We have the debt ceiling coming up. That date moves a lot, and it's dependent on tax revenues and other things. But I've heard anywhere from June to end of August. So, and that's probably going to move. It depends if we have better than expected tax revenues over the next couple of weeks, then it could be pushed out. But it's sometime in, I would say, late summertime. We'll definitely see it come back up, and I think the Democrats, from a strategy standpoint, are gonna plant their flag on that one. That's good. There's gonna have to be a bargain done there, and then the other part from policy, putting tariffs aside, is they have to pass a budget for next year, and they have to pass one before the end of the year. All the taxes from the 2017 tax cuts expire. It seems like the House is working towards that. I heard somebody mention yesterday on CNBC that they're right on schedule. But again, I'm sure with only a few, I think it's 5 seats in the House and maybe 2 or 3 in the Senate, the numbers are awfully tight. And even going through reconciliation, which means you only need a majority, you really can't lose more than 1 or 2 votes. So it's going to be interesting how it goes. And I think from our client standpoint, the one thing that is a bipartisan issue is the SALT tax. So the exemption for state and local, we'll see how that works out. But it makes weird bedfellows because you have Republicans in New York that are against it because of the high taxes there, and so we'll see how that works out. But my guess that gets changed at some point. How much, I don't know, but I think it's 10,000 now. I think my guess is that goes up. So that's another thing we're watching. I think both those policy things are probably summer to fall issues, but you never know.
So Mary, and I'm sorry, Mary, you've asked this twice now, but we'll make sure we ask it. So historically, has the USA or any other countries restructured international trade to the extent that the current administration is doing? And if so, what has happened to the US economy, markets, etc.?
So to my knowledge, the answer is no.
As far as I know, I don't think so
Yeah,
either.
we went from I'm going to get these numbers probably slightly wrong, but the direction is important. So we went from I think a 4% all-in tariff to like a 23%. Now that's come down because of the 90-day pause or whatever. But if everything went through as of today, it would be like 24%, which is a very large jump, higher than we've ever seen over the last 60 years or so. So I guess the answer is no. I don't think anybody has. How again, that kind of goes back to the uncertainty and the wall of worry, how that all flushes out over the next 6 months, and what effects it has on the economy going forward. And I think the economy will adjust at some point. It could be a little painful in the interim if all these tariffs go through. So I think that's really what people are trying to, they're looking for certainty in an uncertain world, I guess.
Trying to see if we got any others. I've got 2 questions for you, John, to end on. But number one, for the next however many months we have left, what will have the biggest impact on the markets? Is it the known variables, as we talked about on this call, right? Which is debt ceiling, tax cuts, inflation, earnings, or is it the unknown, right? Which of those two things do you think has the biggest impact on the markets? And I know I'm not going to hold you to this, but it's always the
I'll go
unknown.
with the unknown.
Yeah.
And I'll tell you why. I've said this to clients, and it's not really a political statement. It's just reality. We had a president over the previous 4 years who gave like what 3 or 4 press conferences, and now we have a president who gives them at 2 a.m. on his plane. So we're going from a garden hose to a fire hose when it comes to these things. And it
Yeah.
really, as we've seen, it only takes one statement somewhere at some point to kind of change the narrative, right? I think, again, it's not political, but the president went to, I think, the UFC fight, and he was on Air Force One at 2 a.m. He was taking questions from reporters.
The good thing about that, by the way, is when he does that, the clock is always right next to his head, right? So you can always tell exactly what time it is. It may feel like behind him, you always know.
To your point, if there's an unknown out there, it's probably going to be something that's said during one of these ad lib press conferences that sends the market to a tizzy, and then they come out and correct it the next day, or either way, just it's a change because we're not used to it. 6 press conferences a day, so there's a lot of data points out there.
Yeah. Other questions, clients? Put them in the chat, please. If not, John, last question from me, right? If someone joins this call and they just joined 2 minutes ago, 1 to 2 biggest takeaways that they should be taking away from this call. They don't need to listen to the hour of us going back and forth. What would you say?
Well, I think we've hit this one a couple times, but don't panic, and I think stay the course. And if you have concerns, reach out to your advisor. We're happy to get on a phone call with you from the investment side, or it might just be something like distributions or something like that. So one is don't panic, and two, I think we're going to get more clarity as the year goes on, and I think if you look out, again, 3 or 4 months is crazy, but if you look out 3 or 4 years from now, I think markets will be higher, and I think you'll be happy that you stayed the course.
Okay, I think that's well said.
And I would love to throw this out there, Mike, but if anybody has any feedback as far as the format change, not using the slides versus more of a conversation, I'd love to hear it. So
yeah, I mean, I was going to end with that too, team. As you guys, we want this to be helpful for you, right? So if it's better to do it this way, happy to make it conversational. We had talked about, I think even on the last one, we'd said that we may move to recording just because we weren't getting good turnout. But obviously with the market, of course, people are more interested, which is fine too, right? We can keep them live. But please share your feedback with us, with your advisor. You can send it to Kristen or Annika. We'd love to hear it, please. So thank you. So with that being said, I think we got most of them questions. And if we didn't, I'm sorry if I missed it. Please reach out. We'll have someone reach out to you, your advisor, if we did. I think we got all of them. So John, this has been fun. This has been good. An hour went by quickly. So I appreciate you. We appreciate the entire investment team. Timely communication, cool heads, right? Commitment to our clients. So thank you. I thank you loud and clear.
Thank you. Take care.
I was going to say, yeah, a couple things, team, as a takeaway. You should be receiving our Fairport perspectives as an email. I think the last one we went out was April 4th. John and team will get those out. If things change, we want to make sure we keep you up to date. So, and if you're interested in more frequent updates, please ask your advisor to email you. We have a weekly market note that we let the advisors choose whether or not their clients are interested. So please reach out if you're interested in seeing that. You can also follow the hashtag investing with Fairport on LinkedIn and Facebook. Hopefully I got that right, Kristen. That's more real-time thoughts on economy. But thank you most importantly for joining, everybody. We appreciate you making the time. It's our privilege, like I said in the beginning, to serve you and your family. We're grateful for the continued trust and loyalty. Please don't hesitate to reach out. Thank you, guys. Wishing you all the best.
Thank you. Take care.